Welcome to Align Spotlight, where you meet your manager. Hey Baird family, this is AMR's Jason Cooper, and welcome to Align Spotlight, where you meet your managers. Today's interview will be conducted by AMR's portfolio analyst Brianna Ellsworth, who oversees Align's international sleeve. I hope you'll stick around for the after show for a timely discussion relating to the non-stop announcements out of China and how our international allocators have handled the heightened uncertainty. Take it away, Bri.
Thank you, Jason. Today we are joined by David Herro, Deputy Chairman and CIO of Harris Associates and the Portfolio Manager of the Baird recommended Oakmark International Fund. David is well known for his approach to international investing and was even named Morningstar's International Stock Fund Manager of the Year in 2016 and International Stock Fund Manager of the Decade in the 2000s. Please welcome David Herro.
Well, hello, Brianna, and thank you very much. It's always a pleasure to speak with a fellow Wisconsinite. I think, as many of you know, I grew up in a combination of Milwaukee, or actually Wauwatosa, and then when I was an adolescent, we moved to Fond du Lac, and I went to University of Wisconsin at Platteville and graduate school at University of Wisconsin-Milwaukee, and also worked for the State of Wisconsin Investment Board 4.5 years, which was my second job in this industry.
Thank you, David, for sharing your background with us. I wanted to start off by saying that Harris Associates is really well known for its value philosophy. And I was wondering if you could talk a little bit about the origins of your philosophy and why it's so unique compared to other value investors.
Well, after I graduated from graduate school, my original intention was to get a PhD in economics. After a couple of years of graduate school and this whole notion of publish or perish, I thought, well, I've always loved investing, and believe it or not, I was interested in it since I was an adolescent. And then I caddied for a stockbroker, and so I would bug him with questions, but I never really had a methodology. I was sensitive to this notion of price to earnings ratio and low PE stocks, but by no means did I have any clue what I was doing. So then, after forsaking academia, I took a job at what was then the Bankers Life, what is today called the Principal Financial Group in Des Moines, Iowa. And they wanted, in essence, someone to start an international investing group, and they thought it was mostly currency, so hire someone with an economics background. So I started researching international investing, and I had this background in economics and especially in microeconomic theory, the theory of the firm, what makes a company valuable, is it's able to sustain above market profit margins. But to me, that wasn't enough. And I actually read the book, The Intelligent Investor by Benjamin Graham. And I thought, oh, this makes really good sense. And Ben Graham wrote about the price of businesses, the margin of safety, et cetera, et cetera. So I kind of came up with my own value concept, which just didn't focus on the price of a business, but you also had to consider what you were getting for the price you paid. Price is extremely important, whether you buy a home, a car, a bag of apples. The price you pay is important. And it's funny how people want to forget this while investing. So that was my roots. And luckily, in 1992, I was recruited by a company, Harris Associates, that shared the exact same view on value investing. In fact, I wouldn't have gone to any other place that didn't share this view. Interestingly enough, I had job offers from like growth funds, because they said, well, you're a bottom-up investor. This is what we want. But I said, no, I don't really believe in growth or momentum. I believe in using the value approach, and I still do. And I think ultimately it is what leads to long-term results.
The next question I have is about how you incorporate risk management into your process. You know, a lot of firms think about it differently. Sometimes they track a certain metric, like tracking error. But could you expand on how you and your team define and mitigate risk?
Yeah, I mean, risk to us really is the probability or possibility of losing capital, permanent loss of capital, or not keeping up with an index in essence. I mean, we are investing, in my case, international and global equities. These are the two strategies I co-manage. And the object is to beat the index. And I would also add, there has to be a real rate of return. Now, we didn't speak of real rates of return for quite some time because inflation was relatively low, but with inflation picking up, the real rate of return as a concept is very important. So that is to us what investment risk is. What causes investment risk? Well, when you're looking at companies, if you see a business, for instance, that has too much financial gearing, too much operational gearing, all their sales in one bucket, these things, for instance, lead to risk. Because if you're a heavily financially geared company and business slows down, and if you're operationally geared, you're in trouble because you're going to lose money and you have financial debts to pay off. So to us, these are aspects of risk. These are characteristics of risk. A lot of people like to compare volatility to risk. And basically the essence is why volatility is not equal risk. I would assert that volatility is used to demonstrate risk only because it's easily measurable. I would say the reason why you don't use volatility as a proxy for risk, because it only represents risk, remember, permanent loss of capital, if you're a trader or if you have a very, very short-term investment horizon. If you are an investor and you have a long-term time horizon, and in particular, if you have access to cash flows or have access to borrowing, certainly volatility is not risk. And we go back to what risk is: losing money, losing the value of your investment.
Thank you, David. Another important tenet to your philosophy is investing in companies with strong management teams who think like owners. And I'm wondering, why is it so important to invest in companies with strong management teams?
Very good question. Who are management? Management are a collection of individuals who control a group of assets under the guise of a company whose purpose is to make profits for those who invested in this business. Think of the simplest concept. Let's pretend I have a Kool-Aid stand or a custard stand. Since it was discovered in Milwaukee, let's say I have a custard stand. And it's not Gillies and it's not Kopp's. It's called David's Custard. And my custard is really, really good. And I get all this business and all these customers that are lined up outside my stand. So then I think, well, you know what, I'm going to expand, but I can't do it by myself. So I have to hire management. So I hire managers to manage my business. And in fact, it gets so busy, I have managers doing all kinds of things. I'm the only owner of David's Custard, and the job of management is to extract profits for me, the owner. Now, let's pretend all of a sudden David's Custard goes public. We have the same management team, but we have maybe dozens or hundreds or thousands of owners. The role of management hasn't changed. We have put the owners, our savings, into this business entity for the purpose of increasing the value of our investment. This is why we invest in this business, to create value. So it's important to us that there exists a management team that understands their first and most important responsibility is to create value for the owners of the business. It goes without saying that this must be done in a legal fashion. There are rules and regulations that governments and society put forth upon us, but they have to operate within this framework. In order for us to invest in a business, you're exactly right. We need to invest with management teams that are both, and this is very important, both committed and capable to create shareholder value for their investors. Committed meaning you're not in this just for show and to enriching yourself. You're in this because you have a responsibility to the owners of the business. And let's take a step back. Who are the owners? Well, look who owns most enterprises, their pension plans and people's 401k plans and their long-term savings and retirement plans. This is money that people need to live off of. And this is why this responsibility is so important. So they might not have the skill set to create shareholder value. So at Harris Oakmark, we seek management teams to invest in businesses where the management teams are both capable and committed to building shareholder value, and we prefer alignment. We want them to eat their cooking. Similar to we at Oakmark, for instance, are some of the biggest investors in our funds. The employees of Harris Associates have close to $1 billion invested in the funds which we manage. We expect the management teams to have a similar enthusiasm. So, in our view, for the price and value of a business to converge, you need proactive value creation. Without this, we call it a value trap. Even if a stock is really, really cheap, if the management is incapable or not committed to building shareholder value, we want nothing to do with the business.
And could you talk a little bit about how you think about non-US management teams compared to US management teams?
I would say it's really hard to kind of stereotype, but there are certain places that are better than others. For instance, I would highlight Japan is a place where you have a very, very weak commitment to building shareholder value. They seem to value other things. You certainly can find Japanese companies that are well managed and that are committed to building value. But for the most part, if you look at the typical Japanese company as an example, has a return on equity of around 7 or 8%. Well, that number in the United States is 16 or 17%. And in Europe, it's probably 14 or 15%. So there seems to be a lack of commitment and perhaps even capability for cultural reasons to build shareholder value. You have the dual problem of persistently low profit margins and persistently inefficient balance sheets that lead to a low return structure. If you go into some places of Europe, there's even few variances within there, but a lot of it does have to do with corporate governance. In Sweden, for instance, you have on corporate boards unions whose pension plans are invested in the business. So guess what? Even though they're unions, they're aligned with the business, and they are certainly all in favor of shareholder value creation. Whereas in Germany, you have unions on the supervisory boards. They don't have shares in the companies, and so they're more concerned about wage rates and benefits and less about the price of the business, the share price. Our job as stewards of our clients' money is to place their funds in companies which do have shareholder-friendly management teams. We had an investment in a French company, great businesses. However, the old management team lost its focus on what its purpose was. And the business performance slipped, the return structure slipped, and eventually, we sold out because of this. And 2 or 3 years later, after we sold out, management was thrown out. We actually invested back into the business because the management team that replaced them was committing to building shareholder value. Big part of what we do is the analysis of the management teams and the board structure of companies. I'm just back from a week in Europe where we spent time with 3 other members of my team visiting companies in the United Kingdom and Switzerland, in France. One of the analysts was in Spain. And one of the big subjects is, management quality and management capability. And this is why it's so important for us as investors to really know and understand who are the managers of the businesses in which we're investing our shareholders' money.
David, thank you so much for those details. Adding to that question, though, over the past year, the Chinese government has enacted rules on companies, interfering sometimes with the management of those companies. And I'm wondering if you could talk a little bit about how you're able to assess both the risks and opportunities when you're investing in emerging markets.
Emerging markets tends to be more flippant in how rules are applied and to whom. But these rule and regulatory changes, of course, happen everywhere. And this is something that we as bottom-up value investors have to be very aware of. What is the notion we have to be aware of is how these regulatory changes ultimately impact the company's ability to create and grow a cash flow stream. Because remember, this is the heart of what makes a business valuable is its cash flow stream. So anything that interferes with the creation or the pace of this cash flow stream, we must consider, including regulatory intrusion. Regulations often are not fair and balanced. In our own country, lobbyists from one industry or the next may tilt the scales on a regulation or may absolve themselves from certain regulations. In a command economy like you often see in emerging markets like China, where you basically have the Chinese Communist Party, the CCP, running the economic show, they could show favoritism, they could be punitive. These things exist. And what we have to do as bottom-up value investors is price these into the businesses in which we're invested in. And if they become so opaque and so obnoxious, it will make the business uninvestable. If we can live with the rules and the regulations, but it just alters the cash flow stream, we have to price into these businesses the impact of these rules and regulations. Step one is to see how these rules and regulations ultimately impact the cash flow streams. Step two is to measure the degree in which there's an impact and whether we can have some transparency into these rules so we then could price this into the business. So, for instance, all else being equal, if a company has new regulations that are onerous or that are not overly onerous, but just kind of a little thorn in the side, we will impact the way we view the business, and we will, as an example, require a higher cost of equity. We will lower the multiple of the business. We will reflect the change in the regulatory environment and how we price the business. So if it's an environment that becomes more favorable for the business, we may increase what we think is the worth of the company, and vice versa. We may lower our worth of the business. So it all depends on what it is. And if it becomes so opaque that we cannot have an idea on how to measure, we won't invest at all. So that's how we try to deal with this. And in the case of China, I think you certainly had the circumstance where some of the regulations, I think, were actually useful and needed. And others, it remains to be seen whether they just want to punish success. So we're watching the situation quite closely, but we have made adjustments to how we value these businesses based on looking at company by company's exposure to these regulatory changes.
Great, thank you, David. The last question I have for you is just about international value in general. It's been out of favor for the past few years, and I'm wondering, in your view, why should investors stay the course?
Post the global financial crisis, when we had a period of slow economic growth, we had extremely low interest rates, was more conducive in some investors' view, in the majority of investors' view, to put higher valuation levels on companies that generate less or no profits. So because of the low discount rate effect and relatively low growth in the real economy, people were looking for any businesses that had top lines that were growing, despite the fact in many instances free cash flow wasn't growing. They were able to excuse this because of a low discount rate, which meant you could afford to wait for those cash flow streams. So this, in essence, has been part of the environment for 10 years or so. And I think the last golden years of value was post the tech bubble, 2000 to 2007, 2008, when you had just the opposite. You had value stocks actually becoming a bit expensive. That was nearly a near decade of strong returns for value stocks. Remember, it was old economy versus new economy. Once the tech bubble popped, all people wanted for 6, 7, almost 8 years was, quote, old economy stocks. Then came the global financial crisis and the 10 years of people wanting nothing to do with, say, value stocks. Where are we today? First of all, the price differential for these businesses almost has never been greater between what we'll say is value and non-value names. So I think you have a more compelling price story than ever before. Number two, what was a headwind in the last decade, slow growth and low interest rates, I think is turning. In fact, it's turning quite visibly. With the recovery from the pandemic, we should see good medium-term economic growth. And with the pickup of inflation, we should see higher rates and the end of lower for longer interest rates, which is almost a perfect storm for the resurgence of value investing, as we had a near perfect storm for weakness in value investing the previous decade. So like everything that happens in economics, you have cycles. And I think we're now about to enter this cycle where we have price pressures leading to higher interest rates, price pressures also being caused by, we all know, with a supply chain, it's what happens when the global economy reopens from a self-induced coma, and you have these supply chain issues. Some of these issues are being caused by regulatory changes. So you have pressure on prices, you have strong demand, and you have a very large differential in prices between value and non-value stocks. To me, is setting the stage for a value rebound. You can never predict exactly when it's going to happen. There were some fits and starts last year and even this year, as we know. But I do believe that this gap in valuations is unsustainable. All you have to look at is a company like Tesla, which in itself, at one point last week, was worth more than the entire global auto industry, despite making a tiny fraction of the profits of the industry and a fraction of the sales. So these anomalies, I think, will eventually become adjusted. And sometimes it takes time for fundamentals to assert themselves. But I think some of the causes of the prolonged spread between value and non-value, these causes are starting to flip. And I think the greater risk is not being involved in value at this stage of the cycle.
Great answer. And thank you so much, David. We so appreciate your perspectives.
Well, thank you very much for the opportunity, and good investing for everyone.
Thank you.
Hey, Bree, that was a fantastic discussion. Thank you for sitting down to dig a bit deeper into Oakmark and some of David Herro's comments.
Thanks so much, Jason. It was great to talk to David Herro.
Diving right into it, David talked about how using volatility as a proxy for evaluating risk is flawed for long-term investors. Now, given Oakmark tends to be a higher vol fund, maybe you could talk about how you evaluate risk in the international sleeve and your decision to stick with Oakmark following the first quarter 2020 sell-off.
That's a great point, Jason. On its own, Oakmark is a volatile fund, and it can experience extreme outperformance and underperformance over the short term. When we assess risk, we try to do two things. One, remain focused on the long term, and two, consider how the fund's risk characteristics fit within Align's international sleeve and the overall portfolio. Looking back at the first quarter 2020 sell-off, Oakmark trailed the benchmark and peers by an extreme magnitude, which affected the overall sleeve's performance as well. We knew from the past that these periods of extreme underperformance are often great buying opportunities, like in 2016 when Oakmark trailed by 10% and bounced back to win Morningstar Manager of the Year. So we didn't want to exit the fund. However, we recognized that we were overweight cyclical value factors. We decided to add WCM to the sleeve and reduce Oakmark and the other funds to balance the risk characteristics. Going forward, we have high conviction in our international sleeve.
Yeah, that was a fantastic change. And for interested listeners, we do have an Align Spotlight episode with WCM. But just sticking with risk, one of the risks that you and David spoke about was, valuing Chinese equities. So you've become a bit of the China expert within PWM, and I'm hoping that you could review the timeline of events that took place this year and the range of responses from some of your managers.
Yeah, happy to talk about that. Let's first think back to 2020. The Chinese stock market actually performed very well last year because many of its companies are focused on technology and e-commerce, which thrived in the pandemic. We started to see a change in China abruptly in the fourth quarter of 2020. The Chinese government stopped the IPO of Ant Financial after Jack Ma criticized the government. Since then, the Chinese government has enacted several severe regulations against its companies. One of the most extreme and unexpected decisions was to make its online education companies into nonprofits. This decision was shocking to investors. And on top of that, we also are seeing turmoil in its property market with the potential default of Evergrande. Many of our managers are keeping a close watch on the developments in China. And each manager has their own view on China. Some might be adding on weakness. But I would say that overall, we're seeing a modest reduction in China because the risks have increased so much.
And I'm sure there are a lot of interested financial advisors out there thinking, well, what do I do with China going forward? So, Bree, maybe you could speak a little bit about your opinion. Where do you think China fits in the portfolio?
One of the most important things for investors to consider when investing in China is that the risks are always present. China is a communist regime and can make sweeping changes quickly. However, as long as you consider that the risks are there, you can manage your expectations. There are a few positives that I still see for China. China continues to be an innovative economy and the middle class continues to grow. Valuations have also come down considerably, which could be a historic buying opportunity. Investors just have to recognize that the risks are different in China. And if you don't feel comfortable making the allocation yourself, you can always consider using an active manager for your international or emerging markets exposure, and the managers can actually make the decision for you.
Great. And Bree, please just keep on churning out those fantastic white papers to let us know what is going on in China. We know the field's appreciated that tremendously. And also just thank you for your time today. This was a fantastic discussion.
Thanks so much, Jason. It was great.
Well, what did you think? It was great having David Herro on to cover value and international market developments, and I hope you enjoyed the after-show discussion with Brianna Ellsworth. We appreciate your feedback as we continue to create premium content. Are there any other Align managers that you would like to hear from? What additional content can we produce for you? Reach out to AMR and we'll be sure to respond.